But if you look at the market action, does that not tell you that investors are skeptical as to whether the Fed can actually bring about this soft landing that so many of us are hoping for?
Well, of course, and I think they're right to be somewhat skeptical because it's a tough call. We have to understand, and I think the markets are right to understand that this is a tough balancing act for the Fed. They're effectively trying to walk a tightrope, and we should also remember that when the Fed has to tighten in the face of much higher inflation historically, they've not been able to achieve a soft landing very often. So we're asking them to defy the odds. I personally think they can still defy the odds and manage it. But of course, there is a significant risk that they don't, that they push the market and more importantly, they push the economy too far and tip it into recession. That is still a very live risk today for sure.
Edmund, what gives you the confidence that there still is a possibility that the Fed can achieve this soft landing?
Well, there are several things. I think firstly, we have to understand where this inflation is coming from. And I think partly there are two sources in the US, shall we say, forget Europe for a minute, just talk about the US. There are two real sources of this inflation. The first one clearly is COVID related due to the sort of supply chain difficulties that we had. And so the fact that goods supply was drying up and that caused really a lot of inflation initially, particularly in goods. And we saw that in car prices, used car prices and so on. And of course, second driver was very much the sort of zero interest rate policy and the quantitative easing policies that just made money extremely cheap. And that, of course, has led to big moves up in things like the housing market. So these are the two drivers of inflation. Because if we look at, again, CPI today, the print yesterday, and we look at the core CPI, which is the surprise, again, bear in mind that nearly 40% of core CPI is related to housing. Housing has benefited massively from the largesse of the Federal Reserve up until recently. And the problem we have is trying to interpret the inflation numbers because the housing components of CPI are extremely lagged with regard to reality in the housing market today. So they really reflect what the reality was in the housing market maybe 12 months ago, which is not very helpful because actually the US housing market is weakening quite considerably, and we can see that from forward-looking indicators. But unfortunately, the CPI is still looking maybe at 12 months ago. And of course, 12 months ago, the situation for the housing market was very different, was actually pretty buoyant. And that's what, unfortunately, we see in the numbers still today.